Hi, everybody. Thomas Morgan here with 1031navigator.com. This is a listener Q&A episode of the 1031 Exchange Passive Income and Investment Series. You can ask your own question at 1031navigator.com/ask. Hey everybody, Thomas Morgan here with 1031navigator.com, and I have actually a client question, but we're going to put it under the listener question category, and that is for triple net properties or any commercial real estate investment for that matter, a multiple state strategy, and that's investing in multiple states around the country and then also pursuing a no income tax state strategy or a low income tax state strategy. One, regarding multiple states, I think that's a great diversification strategy. Let's say you have $6 or $8 million, and instead of buying one Walgreens or one drugstore or one bigger property in one state, one location, to me it makes sense to diversify regionally and divide that up into 2 or 3 deals. And then also, we've done another podcast about it, but you can also diversify with tenant mix also in terms of retail sector, automotive, fast food, drugstores, dollar stores, etc. If you're worried about Amazon or the internet, you could have, one property of each, and then, all your eggs aren't in one basket tenant-wise or geography-wise. So yes, I think a multiple state strategy is important. Number 2, when it comes to the taxes, of course, this is not tax or legal advice. So check with your individual tax consultant or attorney, CPA, whatnot. In my experience, people do prefer the low or no income tax states because who likes to pay more taxes than you have to? But basically, my clients and their CPAs do it one of 2 ways. It depends on your advisor and whether or not, you have businesses in multiple states or you're a resident of multiple states or, where you're domiciled or where you might move. But basically, if you live in one state and you have properties in other states, you're going to either pay taxes in the state you live in or where the property is located. In most cases, people tend to pay taxes in the state they live in, regardless of where the income was generated, and then they take a credit from that other state. There's actually a Supreme Court ruling from 2015. This is beyond my scope of expertise, but basically says that the states can't double tax you. So if you're a resident of California and you buy property in Colorado, let's say, you're not going to pay state income tax in both. You're going to have to figure out a way to justify, ideally how to pay state tax in Colorado, which is around 5% versus 13% or so in California. But that's up to your accountant to do that. Several clients who are in, let's say, California or New York, super high income tax states, they tend to follow a no income tax state strategy where they buy in Florida or Texas or Nevada. And kind of the idea there is that eventually they're going to move. Let's say if they're in New York, they have a home in Florida. Eventually they're going to retire in Florida and not have to pay state income tax there. And therefore their investments can avoid state tax as well. And that's just what our president did earlier this year. So instead of paying New York state tax, he's now a Florida resident. And if there's investments from other tax-free states, he doesn't pay any state income tax. And same with the California clients. I've had, one of my biggest clients moved from Sacramento, had lived in the Bay Area, whatnot, and then moved to Reno, Nevada. Nevada is a tax-free state, so he was able to claim no income tax on those investments, depending on how his accountant set it up. The one catch here is that Florida, Nevada, and Texas are considered what I call Sunbelt states. And so they're going to tend to hold their value better. And that goes into a comparison of of cap rates. The demand is higher in the low and no income tax states, obviously, because people want to avoid those state taxes. But those states, the three main states, happen to be in higher demand just because of population growth and whatnot. So the cap rates for those two reasons are already lower. So, for example, most state income tax rates are 4 to 6%, depending on which state you're looking at. Those other three states have no income tax there, but the cap rates are going to be 50 to 100 basis points lower in those no income tax states already. So, if you do a comparison, let's just pick a deal from the air here. You got a 6.25% cap rate, Dollar General, in one of those normal income tax states. So 6.25% cap rate. And let's say that same deal, same tenant, same lease term, similar location, whatnot, in Texas, Nevada, or Florida might be a 5.75%. So basically, you're already reducing your income by 8% to buy that deal, going from a 6.25% cap rate to a 5.75% cap rate. And so in that case, it would actually make more sense to buy in a 5% state income tax rate and keep 3% more money. But then on the flip side, is your value of the property going to hold more in Nevada, Texas, or Florida, or let's say Colorado, Illinois, or Arizona, where you're paying a higher state income tax? So again, it's up to your personal situation and your accountant, but that's how some of my clients and people, buy across the country, buy multiple states. The triple net business is a national business, and people tend to own property everywhere, and it's not based on being able to drive to your property or go look at the property. You're buying an income stream, you're buying the tax benefits, you're deferring taxes with a 1031. So it becomes a multi-state strategy, and you can, of course, diversify like we talked about. To me, of course, being in the 1031 business, deferring taxes is super important, and minimizing your tax liability is also very important. But to me, when it comes to selecting deals, it comes down to the deal itself. And does the deal have its own characteristics, and does it stand on its own 2 feet? What's more important, saving some state tax income rate, or looking at the deal in terms of the population, the incomes, the traffic, the crime rate, who the tenant is, what the lease term is the building solid construction, what's the square footage of the building, does the property sit on a corner, does it have full access, left, right access, ingress, egress, or is right in, right out only, what's the cap rate, etc. Reviewing all the commercial real estate points first, and then making your tax decision second. To me, that's the best strategy. So open to your comments, questions, and whatnot. So hit us up and have a great day. That does it for today's listener question. Hopefully you got some real value out of that. To ask your own commercial and investment real estate question related to 1031 exchanges and or triple net properties or other passive income real estate, please visit 1031navigator.com/ask. Again, that's 1031navigator.com/ask. You can also leave a question by leaving a direct voicemail at the podcast hotline 970-300-1994. Again, ask your question by leaving a voicemail at 970-300-1994. Thanks for listening to the 1031 Exchange Passive Income and Investment Series. Hopefully it's helping you create, build, and protect your wealth. Talk to you soon.
And remember, this show is provided for your informational and educational purposes only. Be sure to check with your accountant, lawyer, and or other tax professionals and advisors before relying on this information. Although the information contained herein is believed to be accurate and reliable, we do not guarantee its accuracy or completeness, and it is provided without warranty. Common sense is the best practice.